Good morning, ladies and gentlemen, and welcome to the Futuregrowth webinar on Investor Activism in Action. The fight for a more equitable listed bond market continues. The development of listed capital markets brought with it the promise of high standards in issuers, more transparency in reporting, and more liquidity in trading. Equity markets developed much earlier than debt capital markets, with the real rise of debt capital markets, bond markets, coming in from the 1980s onwards. Broadly, bond markets do not appear to have been established with the same standards as came to be expected in listed equity markets, nor have they evolved in that direction in any way that is satisfactory. The terms under which people buy listed bonds, as you will hear today, are often not up to scratch, not fit for purpose, and in some cases violate the principles of sound lending. And when things go wrong, they leave investors with very few protections. That's what we're here to discuss today, which is the improvements of standards in the debt capital markets. My name is Masiabi Marageni, the head of Futuregrowth Business Development. And in this Women's Month, and with me here today, is two industry stalwarts, our very own head of credit, Olga Constantatos, and Jill Rain. Jill Rain is a senior policy advisor at ASISA, and she is responsible for the Fixed Income Standing Committee. Jill has over 30 years of experience in banking and financial markets, and she's been actively involved in developments in the capital markets from its inception. In her career as a merchant banker, this has included a large role in funding corporate SA. So welcome, Jill, Olga. You two are women who are driving meaningful change in this industry. Could you please take us through your own personal story? Jill?
Yeah, so I always wanted to be an academic. So there I was in the early 80s, teaching finance and econometrics at UCT as a junior lecturer. And I was asked, what is the dirty price of a bond? Nothing to do with efficient markets and Markowitz. What is the price of a dirty bond? And I didn't know. And the price, a dirty bond means a bond with accrued interest. But anyway, I decided that if I'm going to be a teacher of finance, I really need to go and experience finance. And that was bonds. So now, 37 years later, I'm still here in the bond market.
You are, Jill. Olga?
Hi, Masiabi. Hi, Joel. And hello to everybody that's listening into this conversation. Yeah, so I started my career off as a CA. Well, I am a CA. And one of my very first audits was the audit of Cape of Good Hope Bank, which doesn't exist anymore. It was absorbed into Nedbank many years ago. And I was responsible for looking out for and auditing the lending arrangements of Cape of Good Hope Bank. And that's really what sparked my interest in credit. And I've really been in credit fixed income for most of my career since finishing articles.
Thanks for that. Olga, could you please explain what is a debt listing requirement?
So the debt listings requirements are the rules under which the JSE effectively regulates the issuance of bonds. And what is a bond? It's effectively a loan agreement between the institutional market, i.e. asset managers like Futuregrowth, and issuers on the bond market. So the JSE has set up this marketplace effectively for borrowers and lenders to meet, and the debt listings requirements are the rules under which those borrowers and lenders can meet. And it regulates things like the types of issuers that can issue debt on the JSE. It can't just be, any old person. There are particular standards that have to be met. It also regulates the financial and reporting obligations of those issuers. So in terms of regular financial reporting to the market, sends notifications, things like that. It also regulates the listings requirements, ongoing obligations, and generally the rules, of the bond market. That's what the debt listings requirements are. It's the rules of the marketplace, effectively, where we, as lenders into that market, meet the borrowers.
So, Olga, if I understand you correctly, so as an investor, if I want to access a listed instrument, so there are three things that I need to look out for. I want to be protected. I want to know that this reporting are standard and that they delivered on time, and also the fact that there needs to be liquidity. Does that sort of sum up the listing requirement?
Yeah, that's right. It does govern some of those requirements. I mean, I think it's important to note that the debt capital market is different to the equity capital market. As an individual, you can go and buy shares in your own name as and when you like. You can't do that in the debt. You can't buy as an individual a bond. You would access that either through a retail fund, like an income fund or a money market fund, or you would access it through your institutional pension fund. But absolutely, there is a need for transparency. There is a need for liquidity. There is a need for tradability. Just like there is that need on the equity capital markets, the same needs to exist in the debt capital markets.
Jill, can you take us through some of the history of why we're here? What has happened to make this an issue for investors?
Okay, so it hasn't been a short process. Actually, if you look at the slide, it looks as if it's been a 2.5-year process, which actually it started before 1988. Because remember that bonds haven't or don't trade on the JSE. They're listed on the JSE. The last time they traded on the JSE was before 1988, when the Jacobs Committee report was released, because pre-1988, you had bonds on open outcry between brokers on the JSE bond floor, and you also had bank trading on screen. After the changes in 1988, everything moved to be over-the-counter trading, on screen, by telephone. So, it's important to remember that the bond market was with the JSE, and actually it remained linked to the JSE until 1996, when the Bond Exchange of South Africa was formed. And it was only in 2009 that the BISA, as it became known, was taken over by the JSE and moved back to the JSE. But it turned to a market was very equity-centric, and the focus of the equity listing requirements is very much towards issuers and rules rather than investors and principals. And this is important because any listing requirements must be fit for purpose for the structure of the market, because their goal is investor protection. So you need to be sensitive to the way the market has evolved. Now, if you look at the Eurobond market, when it comes to negotiating the clauses for investor protection, i.e. under the base prospectus or what we call the program memorandum, there are two sets of lawyers. There's a set of lawyers for the arranger and the investors, and there's a set of lawyers acting for the issuer. And they're both paid for by the issuer, because guess what? The issuer wants to borrow money. But in South Africa, it's evolved in a different way. There is one set of lawyers that acts for the arranger and the issuer. And the investor doesn't get its independent legal counsel. They are required to do their own commentary, which is very, every asset manager has to do their own work, and it becomes a very arduous process. So, that's the kind of issues that we're trying to address. The fact that there is only one lawyer, and it's not looking after the interests of investors.
Yeah, Jill, can you just go back to your point? What are arrangers in simple terms? Do they buy the bonds? They themselves sell?
No. Arrangers are banks who have a division that basically puts in place the documentation and deals with all the listing requirements, works with the JSE. And in terms of technicality and legals, they subscribe, but actually they don't invest directly. And certainly, even if they do, the arrangers are not the members of the bank who actually invest. There has to be a separation between the banks acting as an investor, which is in public markets, and the banks acting as an arranger. Chinese walls.
Interesting, Jill. I mean, are you perhaps saying that investors may not fully understand the risks that they are taking?
Well, I would hope that, professional portfolio managers are aware, but they need to have contracts to assist them, because when things go wrong, that's not when you play nicely. You need to have strong legal documentation in place before you commit the money that you're managing on behalf of your clients.
Thanks, Jill. Olga, I mean, can you tell us what progress has been made to date and, what more must be done to ensure that investors are protected?
Yeah. So, I mean, what Jill's mentioned is the fact that the market is structurally flawed and structurally biased, actually, against investors. And so that's really what we've been trying to address. We've been trying to make this marketplace where borrowers and lenders meet, we've been trying to make it a fairer marketplace. And structurally, how we've tried to address that is through these amendments to the debt listings requirements. So you saw on that slide multiple rounds of discussions. We've ended up with amendments to the debt listings requirements, which have given us some better protections. The problem is, and the reason why we've wanted these the structural unfairness, I guess, to be addressed, is that the bond market violates almost every practice of sound lending that you know. So, for example, the legal agreement thing that Jill was mentioning just now, in any other loan agreement, you can take yourself with your home loan or with your car finance, you apply to the bank for funding. The bank is the one lending you the money. The bank is the one at risk. They are the ones that dictate the terms and conditions under which they are prepared to lend you money. They'll say, we need this security. You have to have this level of income. You have to give us a statement of your assets and liabilities. Your tax affairs have to be in order, whatever their requirements may be. But critically, it's the lender in that environment that is setting those terms. In the bond market, it's the other way around. The issuer, the borrower, is the one who basically arrives at the bond market with a set of legal agreements that are predetermined by them. They are setting their own lending terms. And us as the institutional lenders into that market traditionally have had very little scope, very little ability to negotiate for proper lending terms. So what we were trying to address through amending the debt listings requirements is to lift the regulatory standards and to allow us a proper platform for negotiating sound lending terms. We weren't asking for the market to be skewed now in our favor. We were just asking for the market to be fair and that playing field to be fair. And so we did get some wins in the amended debt listings requirements, which were approved towards the end of last year. And some of those include much higher standards of reporting and particularly around corporate governance practices. So there's now a requirement for issuers to regularly disclose how they manage conflicts of interest. We've seen multiple cases of conflicts of interest that result in financial problems further down the line in very many of our corporate and state-owned entity capital markets issuers. So there's now a much higher standard for disclosing conflicts of interest, specifically also around politically exposed people, PEPs, or they're called DPIPs, domestically prominent influential people in the debt listings regulations. Much higher requirement to disclose contracts with PEPs or DPIPs, and that's embedded in the regulation. So that was a good thing that we got. The other improvement that we got, although it didn't go quite where we wanted it to go, is the appointment of somebody that's known as a debt officer. We were wanting an independent debt officer. And why do we need a debt officer? Usually when things go wrong, we as the lenders, the institutional lenders, are fragmented. There's 10, 15, 30, I don't know, lots of institutional asset managers. We need somebody to talk and negotiate together for us with the issuer. And so what we wanted was
Olga, could you just repeat what you said? Because you just got cut there a little bit. Thank you.
Oh, sorry. So what we were wanting is the appointment of a debt officer who can negotiate collectively for us as lenders into that market when things go wrong. So the regulations now allow for a debt officer to be appointed, but the requirement is issuer. So they are a senior employee, but they are still an employee of the issuer. So when things go wrong, it's not they're not independent. So they're not necessarily able to act for us. So that was a part win that we got. Okay. The other thing that we got is a much more improved investor meeting framework. So now the chairperson of an investor meeting is appointed by the lenders, rather than previously the issuer could appoint the chairperson, which is clearly in Equitas. And also the voting mechanism is much fairer. Previously, voting was allowed by show of hands. So whether you held 10 million rand of a bond or 100 million rand of a bond, your hand was one vote, and the voting was done according to a show of hands. That's now for everybody.
Okay, Olga, you just went quiet there a bit, but I think just to summarize what you were saying, you know, a person with 1,000 vote versus a person with 1 million versus 100 million, they should obviously, the quantum which they have should be represented in the amount of votes that they have. Is that correct?
Exactly. And that's now the regulations now allow for that, whereas previously they didn't. So the regulations have moved us some of the way forward in terms of embedding some investor protections in the regulatory framework.
Thanks, Olga. Jill, would you like to add on to that?
Yeah, I think we must make it very clear that the buy side or the investors are not being disruptive or destructive. They're not trying to make it more onerous for an issuer to list a bond. They're merely trying to communicate to an issuer what the requirements of the buy side, the bond portfolio managers, what their requirements are in order to fulfill their fiduciary responsibility to clients. And that, you know, there are things that are just not fit for purpose. Olga mentioned calling of meetings, 21 days notice. Doesn't work in the bond market, because if there's a potential event of default, you can't wait 21 days for a meeting. You need to take corrective action now. And you also have a situation where equity investors get to vote on asset disposals and unbundlings, where in many times bondholders don't get that right. And so we're trying to make sure that issuers understand what investors require, because if they don't tell them, the issuer isn't going to know. And they obviously are going to look after their own interests. They're not going to think about the benefits to investors. And so we've got to tell them. And, you know, I think in many respects, bondholders are treated differently from equity investors. I mean, think of it. How many times are there IPOs? How many times are there rights issues? And yet management of listed companies will go and see equity holders twice a year, interims and finals. With bondholders, you know, a large corporate might be a frequent issuer in the bond market several times a year. But sometimes you almost get the feeling that issuers go and visit bondholders when they want new money. Sorry, that sounds a bit cavalier, but, you know, one does get that sense. And, you know, I think Olga's already alluded to it. You know, we get asked, you know, will you give us better pricing if we accede to some of your requests? Well, it's like me saying to the bank, well, if I don't like your terms, you know, if I change my terms, if you change your terms, then will you, you know, sorry, if you know, will you give me a better price if you change your terms? You know, it's just, as Olga said, it's the wrong way around. Investors are just looking for protection against the downside, because, you know, the best thing that can happen to a bondholder, okay, apart from earning the interest, is being repaid your capital. And you need to be paid for you're only paid for credit risk. You're not paid to assume managerial action. So we need contractual clauses to actually say when there is management action that significantly affects the assets of the company, bondholders, either it must be an event of prepayment or, there needs to be some form of compensation. So that's
I
all we're
hear
trying
you.
to communicate.
Yeah. Should there not be a lender's legal representative, Jill?
Well, there should be, but remember, you can't have a lawyer representing lenders because, I mean, a lawyer will only report to a individual, not to a body of people who might be investors in the future, which is why the structure has to have some form of coordination. That there must be a trustee, or as Olga alluded to, some form of debt officer who has an agency role, and then can negotiate with the lawyers on behalf of the investors. That's what we need. You're not going to have any lawyer who's going to report to 30 or 40 investors. It's not going to happen.
Olga, there seems to be some wins for investors here, but in many ways, I mean, the revised debt listing requirements are still lacking. Are there covenants? Is there security? Can you tell some of the shortfalls that we're experiencing here?
Yeah. Short answer is no, no covenants, no security. Yes, I mean, there were some wins, but there are some significant things that are lacking. And Jill has mentioned a few of them, and we can unpack some of those now. So the one around fundamental transactions and the risks of management action, what you would normally have in any lending agreement is some protection that the entity that you are lending money to today maintains that a certain level of cash flows, a certain level of assets for the life of the loan, whether it's 3 years or 5 years or 7 years, so that you have some line of sight that you've got a reasonable chance of being repaid based on your assessment today. And how that normally works in the lending agreements is the protections are built in to basically say, to the extent you sell off a material asset or material subsidiary, then there should be compensation for us as lenders, because now the credit risk has changed. Either we need to be repaid or we need to be earning a higher rate of interest because now there's a greater credit risk. So that's one of the things that we wanted built into the regulations, is an obligation on issuers to effectively give us as lenders some rights when they make significant changes to their business. And this is not to be restrictive or to tell them what to do. It's really as a means of protecting our clients' money that is effectively being lent into an entity that looks like this today, and we wanted to reasonably look like this in a few years' time when our money comes to be repaid. So that was one of the shortcomings that we were not able to get in the regulations. The other one is an important one, and Jill mentioned it in terms of legal, and the points that she was making are true at the pre-issuance phase. So before a bond comes to market, there are no investors. They do a roadshow, they show us the legals, we can comment on them, but until you've actually bought the bond, you're not a lender into that market. What we wanted built into the regulations is a legal advisor once you have invested into a bond under particular terms and conditions, which are all documented in the loan agreement effectively between us as lenders and the borrower. That's known as a domestic medium-term note program, a DMTN. What we wanted in the regulations is, to the extent the borrower was not meeting its obligations. Now, remember, these obligations, they've signed up to them in the legal agreement for financial reporting, that particular things that they're going to do to pay you interest on a particular date, to repay your capital on a particular date. To the extent that they were not meeting those obligations, we wanted as lenders, which is a very normal right, by the way, in any lending agreement, we wanted the right to be able to appoint one legal advisor to represent all the bondholders to effectively negotiate for us. At the end of the day, credit work, the bulk of credit work actually is legal work. The rights and obligations that borrower and lender have, those are documented in the legal arrangements. And so when things don't go according to plan, which invariably they do, life happens, right? you then need to look to the legal agreements to say, well, what are my rights and obligations? What can I do? And we need legal advice to be able to do that. And it's not efficient for Futuregrowth to get one set of legal advisors and all the other 15 asset managers who may be invested in that same bond to get their own, 15. So then you've got 16 legal advisors. It's not efficient. Usually in syndicated loan transactions, there's one legal advisor that's appointed to act for lenders. And all we were asking for was for a similar arrangement to be built into the regulations. And it's important to note that we didn't want this in every single instance. Nobody wants to rack up costs unnecessarily. All we were asking for is legal protection in instances where the borrower is not meeting their obligations. And we were not able to, the JSE was not able to include that in the debt listings requirements. It's a significant shortcoming. The other one I alluded to earlier was the independence of the debt officer or the trustee, as Jill mentioned. When things go wrong, it's really not helpful for us to have somebody looking out for our interests who's effectively working for the other side, who's employed for the other side. There is no independence. They are not able to act really as in an agency role for us. And so, yes, it's better to have a debt officer than no debt officer, but it's certainly not what we wanted, which was an independent trustee, actually, is what we wanted, which is what they have in offshore markets. And then the other thing that we wanted is an obligation built into the regulations that each issuer is obliged to tell the market or to disclose to the market comments on legal, so that we would know, to the extent we are asking for default interest, we know there's 12 other institutions also asking for default interest. It gives us as individual asset managers a much stronger negotiating platform when we know that we're not the only ones, asking for these changes. And so we wanted that transparency to be built into the regulations, and also on a no names basis. So it wasn't important for us that 91 says this and Prescient says that. Not at all. We just wanted to know that investment manager A, B, C on a no names basis, so that we know, okay, this clause is being asked for, we're asking for it, and we know 6 others are asking for it. It's an important one, and we can each then negotiate for better protections to be embedded in the legal agreements. Because remember, it all sits in the legal agreements at the end of the day. That's what you turn to when things go wrong.
That's right. Olga, sure. If what you're saying is true, then why do investors still buy bonds?
Well, this is the thing, right? Listed bonds are listed, and there's a misconception, I guess, that listed means tradable, listed means there's price discovery, listed means liquid. And that isn't always the case. Like if we look at the Land Bank example, when it went into default last year in April, it had listed bonds in issue. It publicly went out and said, we are not able to meet our obligations as and when they fall due. You would think that they would react in some way, right? That the spreads would blow out, the value of the bonds would drop because now they can't meet their obligations. The bonds should not be worth the day after that announcement what they were the day before. But yet we didn't see any of that. We didn't see any trading. We didn't see any price changes for quite some time, actually, after the Land Bank event of default. And I think that really just illustrates that listed is kind of known, and our regulations are built this way and mandates are built this way on this assumption that listed means in some way safe, tradable, and I can get price discovery on them. And this actually, isn't really the case. And so the alternatives that you have a few alternatives, right? You can not invest, but then fulfill your mandate in that regard. You can also perhaps change mandates or change the regulations. That's a very, very long process. Or you can do what certainly Futuregrowth and I think other asset managers have also done with this ASISA process, is to the bond market more fit for purpose, to allow for better transparency, better disclosure, which will result in hopefully better listings, better liquidity, and to raise everybody's awareness that just because something is listed doesn't necessarily make it safer. There are dangers, I guess, in a way that you need to be alive to. You can't assume just because something is listed that it's automatically safer. That's actually not the case. And a lot of our unlisted loans, we are able to negotiate much stronger lender protections than we can in the listed market. And so I think it's important that investors and the asset owners into this market are aware that listed doesn't necessarily mean safer. But what we're working towards is, from a regulatory perspective and from a fundamental legal perspective, is to try and make it safer. That's what we're trying to do, change the market to make it more fit for purpose.
Yeah. Jill, I mean, if the terms are not acceptable, then why can't just investors change, get better terms?
Well, they do try. but unfortunately, the means of communication is quite difficult. In any lending relationship, what is important? The borrower and the lender. But somehow, when it comes to listed bonds, you've got a set of regulations that are also there to deal with, what's required under the Financial Markets Act and to deal with some of the more technical requirements of the Johannesburg Stock Exchange as a self-regulatory organization. But there are also these, what we call commercial terms, that need to be negotiated so that the issuers are aware of what the buy side or the investors need to see. So that's what the guidelines were, the ASISA guidelines that we've drawn up were intended to do. Remember, they are guidelines. They are not requirements.
Absolutely.
And that's
And let's get
important
into that, Jill. Let's get into those
see,
guidelines.
Well, it's important that there are guidelines because you don't want to do anything which is anti-competitive. But it's merely to indicate to issuers what the requirements are. And there's a honeycomb of requirements. They're not, this is not a document. This document is not 55 pages or 100 pages of requirements. It's relatively concise, and it lays out what best practice is seen to be by issuers. And look, it's not uncommon to see this. In the Eurobond market, for example, the International Capital Markets Association has what they call the primary market manual, which is just a way of, how to do things in the best way. And that's what we were aiming to do in this document. And look, in drawing them up, it was negotiated. There was a small subcommittee of the ASISA Fixed Income Standing Committee that worked together to establish a document, which actually we have been working on probably since 2016. But to get that, in a concise form that could be used to share with arrangers and borrowers. So the subcommittee produced this document. It was then shared with all the 35 or so plus of fixed income standing committee members, and it was approved by the ASISA Investment Board. So it has widespread support from the investor community. It's by no means been a few disruptors just putting guidelines that they want to see. It's industry.
Yeah. Okay. So
And
those
I can just
35
add,
would be other asset managers. Would the 35 standing committee members be asset managers, end clients? I mean, what is that structure looking like?
Yeah, so it's asset managers, because remember that pension funds generally now do not manage money directly. They outsource the management to asset managers. So it's asset managers and also the large life companies who, they invest in credit as part of their guaranteed annuity portfolios, as well as some of their endowments, as well as client money that goes into unit trusts. So yes, it's across the industry.
Okay.
Managers of pension fund money, life money, and unit trusts.
Thanks, Jill. Olga, you wanted to add
and I think
something?
it's also important to add. I mean, absolutely, they enjoy widespread, institutional support in terms of the investment market, the buy side market. But I also think in drawing up the guidelines, it's important to state that all of the principles outlined in those guidelines, which are available on the ASISA website, were in direct response to lived experiences that we had. These were not some esoteric, nice to have. In an ideal world, it would be good to have them. They were drafted as principles in response to actual events that we had experienced, where we couldn't get hold of other investors, we were not able to meet, we were being fragmented in terms of negotiation, we didn't have access to legal. I mean, I could go on. And so the principles, and they were drafted in a very intentional way to be practical, and to be responsive to events that we have actually experienced, and it's our lived experience, and we must as we learn more and learn from mistakes potentially in the past, so we must do better. And this is a response to that in terms of all of us as institutional asset managers doing better by our clients.
Olga, can you give some practical examples of how that will work? How is this now going to benefit clients?
Yeah. So if I think back to some of the shortcomings that I was talking about, one of the shortcomings of the market is effectively that we as lenders are fragmented. In syndicated loan transactions, as lenders, you would be able to get together, you would have one legal advisor acting for you, would be able to share your comments, there would be transparency around, oh, this is an issue for me, yes, it's an issue for you, let's build it into the legal agreements. The structure of the bond market means that we are fragmented. We are not able to negotiate terms or agree a position as lenders and then present that. So what we've asked for in the principles, what we've built into the principles, is something that we were not able to get in the regulations. And that was a requirement for issuers to be transparent around the markups and the terms effectively that other lenders, all lenders, all of the buy side may not find suitable. And so to the extent we are asking for a particular term, it's useful for us to know that others are asking for it as well. It creates that platform for negotiation. So that's one of the principles that are in there. We've embedded a principle for transparent issuance phase around legal terms and conditions. And that really has been as a response to our lack of negotiating ability as a collective. It's our clients' money at the end of the day. We should have some say in the terms and conditions under which that money is lent in terms of building investor protection. So that's one of the requirements. The other one or the principles rather, not requirements. The other one is around legal. We intentionally drafted the wording that to the extent the borrower is not meeting their obligations, there's some default, they're not able to pay their interest, they're making some significant change to the conditions under which we have transacted, that we would then have the ability to appoint a legal advisor to act on our behalf, paid for by the borrower, which very standard lending term as well. Do you think that when you want to change your mortgage bond for whatever reason to increase your mortgage or whatever, the legal costs are paid for by the bank? They absolutely are not paid for by the bank. They are paid for by you as the borrower. And we were looking to embed that effectively in the principle. So that is another one of the principles that we've got. And Jill talks about the honeycomb. There's about 8 or 9, I think, principles that we've spoken to. And it really is to embed better market practices into the bond market, given that we were not able to get a regulatory answer for some of the very significant shortcomings that we experience almost daily.
Olga, I would have thought that the JSE would support, in the name of fairness and transparency. Where's the JSE on this?
Well, and Jill mentioned it earlier, the JSE effectively regulates its own exchange, right? So the JSE is an exchange. The JSE has a business model of itself. It's listed obviously on its own. It has a business model of attracting issuers into the market. It earns fees for having listings on its exchange, and the way the regulatory framework works in South Africa currently is that the Financial Sector Conduct Authority, which has effectively regulatory authority, has delegated that authority to the JSE as a self-regulating organization. And so the JSE effectively is, in a way, a player because it wants lots of issuers to come to market. So in a way, it wants the standards because it wants issuers to come. So the issuers don't want particularly stringent standards. So in a way, it's kind of incentivized to that. But at the same time, it's also required to regulate this meeting place, this marketplace of buyers and sellers of corporate debt, corporate and SOE and other debt. And so there is an inherent, I guess, conflict in a way that it's a player referee in a game where it makes up its own rules as well. The debt listings requirements are its own rules. And so there was a process of negotiation and trying to, I guess, get the JSE as the regulator to understand the concerns that we had. And we did we did get some wins, in that the listings requirements of today are very definitely better than the listings requirements of, a year and a half or 2 years ago. But they certainly didn't go all the way that we wanted to. And the response to some of the additions that we wanted built into the regulations, the response from the JSE was that these are not matters for regulation. These are matters for commercial negotiation. And so what we're trying to do then with the ASISA guidelines is to create a platform for that commercial negotiation so that we and the issuers can understand what is required, what is best practice standard in terms of terms and conditions that we were not able to get a regulatory answer for. And that is effectively what the ASISA guidelines are. And it's in response to the JSE kind of meeting us some of the way, not quite all of the way we wanted to go.
For this initiative to be effective, it's critical for the industry to come together, and this includes people who are responsible for managing pension fund money. So what can our industry colleagues do to help drive this change?
Olga, you better take that one.
So I think it's important to understand that we are all players in this market, right? This kind of change isn't going to happen by one manager saying this is how it has to be. And what we have gotten is industry buy-in that the market does need to evolve. We have all felt the pain of defaults. We have all felt the pain of working through restructures. We have all felt the pain of these weak legal terms. And frankly, our clients have felt the pain in terms of losses, in terms of, the defaults effectively. It is their money. And as fiduciaries, it's incumbent on us to effectively drive the change that we need to see. What can the rest of the market do? There's lots of players in this market. There's other institutional asset managers. They can, as they have endorsed the ASISA guidelines, they can also act to incorporate them into their decision framework and negotiating platform using the work that's being done effectively to create these better standards. But importantly as well, the asset owners, the people whose money it is, so trustees, those of you that sit on pension fund boards, etc., it's up to you to ask your asset manager, the person or the institution that you've entrusted to manage money on your behalf, to ask them, what are you doing to manage my money in a way that's in compliance with these guidelines? We recognize, certainly as an industry and certainly as Futuregrowth, that this is not an immediate thing. We're not going to get everything tomorrow, the next time an issuer comes to market. There is a process that we need to go through. But it's important, I think, for asset owners to ask the question of their asset managers, what are you doing to incorporate these frameworks into your investment decision making? How are you negotiating these provisions into loan agreements that you are making on my behalf? And what are you doing effectively to be the change? It sounds corny, but what are you doing to be the change that the market needs and has agreed is needed?
Absolutely. Olga, that sounds like a call to action. The next phase definitely requires all investors and asset owners to come together to make this a success. And it's up to the asset owners to also just drive that change. Jill, just in parting, what's next? This journey seems like a difficult one. So what is next in line?
So there's no point at which we're going to say we're done. It's a process because the market is evolving continually. So there's constant change, there's constant improvement required. Just to put it in perspective, in South Africa, we only have the concept of it's either unlisted or we have, regulated markets in the form of stock exchanges. But there are in other jurisdictions, alternatives. And we are moving towards amending the Financial Markets Act that will allow for these non-exchange exchanges that, creates alternatives for investors, particularly in debt, in private capital, like you see private equity. Private debt is also going to evolve, but, the structures that need to be used are very cumbersome. So we just have to keep working and making sure that we're aware of what's happening around you and that the regulatory, or not the regulatory framework, but certainly the framework is fit for purpose. Because, I said I've been in the bond market now for 37 years, and I can assure you that the bond market today is very different from the bond market in 1984, when the Reserve Bank every couple of months would change the interest rate on their 10-year government bond. It's just very different. And, it's a big market. There's 3.2 trillion of bonds outstanding. Admittedly, a bulk of them are government securities, but it's not an insignificant market.
Thank you for that, Jill. Jill, just maybe before we go into the poll and the questions, do you have any parting statement that you would like to give in terms of the call to action for asset owners?
I think one just has to be aware of mistakes that have happened in the past. If you don't understand history, you're going to make the same mistakes. And we're trying to indicate that, there have been defaults, there have been errors, and we just need to ensure that there's a remedial framework or remedial action when things go wrong. Things are always going to go wrong. So let's be prepared for when they do go wrong, because it's not if, it's when. So
Thank you, Jill and Olga. It was a wonderful panel. I think we'll now go into the questions and hear what our audience has to say. Shall we put up maybe the poll so we can see what questions have been asked and how the respondents have responded? Okay. Okay, then I'll just go to the top questions that have been asked. I mean, given the experience at the Land Bank where the situation of investors has not been addressed, how would these changes you mentioned have made things better? Olga, do you want to maybe answer that?
So,
Yeah, in a number of areas, right? If we were able to better negotiate the terms and conditions of the land, the DMTN, that loan agreement effectively. For example, default interest would have been ticked on. So that what that means is that when Land Bank went into default, because it wasn't ticked on in the documentation, there was no ratchet up in the interest rate effectively that we were earning. So now there's an entity in default, it's paying the same interest rate it was paying before it went into default. That's clearly wrong. So a lot of the better negotiating platform could have been there. I mean, the Land Bank default, Jill will attest to that. There is no investor representative, appointed. Thankfully, the Land Bank actually, and we were reliant, I guess, on them allowing for Jill to be appointed as effectively our independent representative. But critically, she's not paid for that role. ASISA, she's got a full-time job at ASISA, and so ASISA very kindly kind of loaned Jill, to us, but no kind of to ASISA, and would be paid for their role. I mean, the meeting framework, it took, in terms of a register of note holders, there's now a requirement for issuers to keep an up-to-date register of note holders. Land Bank went into default. Jill, I mean, you can say the story better than I do. How long did it take you to figure out who the Land Bank bondholders were?
Okay, so let's just be quite clear. We know who the ultimate beneficial owner is. So it's ABC Pension Fund. But the key thing is to be able to identify who's managing that particular money that belongs to ABC Pension Fund. Right. Asset manager X, Y, or Z. And that's what takes the time, that the beneficial ownership download does not include that information. So, you basically, it took me 2 weeks to decode who the owners were of some 36 billion of notes.
Yeah, and in a default.
Sorry, I think obviously. Did you get cut there?
Yeah, I think if I can also just add that, I mean, I think Jill said it took her 3 weeks to figure out who the ultimate beneficial owner was. And you can imagine in an event of default, 2 weeks, where things are going wrong, time is of the essence. It's very difficult. We couldn't do anything as investors. They've defaulted, and now 2 weeks had to go by before we could even see who owned or who was managing the bonds, to be able to call a meeting to know what to do. So there's a lot in the learnings from defaults like the Land Bank and others, they're not the only ones, that are in the regulation, in the ASISA guidelines, as a response to real lived experiences.
Here's another question around arrangers. I mean, we spoke about who arrangers are, that they're banks. Somebody's actually asking the question again, what is the role of the arranger? So maybe do you want to maybe repeat that in a short sentence, Joel?
Yeah, so the role of the arranger is to work with the issuer to deal with, if you look at a document, what we call the base prospectus or program memorandum, you've got to document risk factors, you've got to document the terms and conditions of the note, the disclosure, the annual financial results, all the company information, use of funds. And so that's what the bankers do, as well as organize roadshows to go and engage with investors. So that's what they do. Documentation and process, as well as insights into, which investors have an appetite for particular types of debt. Sometimes senior, sometimes subordinated, securitization, project bonds. So that's the role they play.
Thank you. Another question is, what is the size of the credit market versus the government bond market?
Well, as I mentioned, the total bond market is approximately 3.2 trillion. And when you say the credit market, one has to be a little careful because it's non-government securities. And that includes bank bonds, securitization, corporate bonds, and then state-owned enterprises and municipalities. The actual true corporate debt, excluding banks and structured products, which are issued by banks, is probably 200 billion. So it's relatively small, and it's grown quite substantially because remember, the first equity was listed in 1897 and bonds only came about 100 years later. But I mean, bank bonds are a significant part of the capital market at this point, not only through direct senior notes that are issued by banks, but also subordinated debt, credit-linked notes. There's securitization paper of around 35 billion. So it's diverse. But, the big issuer clearly is government, which is about 2.8 trillion.
Here's another question, Jill, around, have the proposed debt listing requirement guidelines already been approved by ASISA to address the shortcomings?
Yeah, I mentioned that it was presented to the ASISA Investment Board. So the answer is yes.
That was in March of this year, Jill. That's correct, eh?
Yes.
As of March 2021.
Another question is, why can the JSE not appoint a legal advisor that represents bond investors' interests? I think you've also highlighted there in terms of the separate interests. Jill, do you want to
their
maybe just
response
clarify
to our
that?
request for that, yeah. So their response to our request for that was that that's not a matter for regulation; it's a matter for commercial negotiation, and so that was their response. We fundamentally disagree, but So maybe it's a question to ask the JSE.
No, but having said that, Olga, one has to be clear that as I said before, you can't have a legal advisor representing investors. You can only have a legal advisor representing a real person. And, as I said, in the Eurobond market, it's the arranger who performs that role for investors. But we don't have that person in South Africa. That's the problem. And that's why actually our big ask was more for legal representation in the event of corporate action, management action, and in the event of default. I think we were very fortunate with Land Bank that legal counsel was appointed to represent the interest of investors. And, there's a committee of the major investors who are the reporter, or the lawyers have a duty of care to those particular committee, or that particular committee. So that was what we were really asking for, because, I don't think we're going to change the structure of the bond market. It is what it is.
Yeah.
Well, maybe we will. Maybe I'm being not sufficiently optimistic, but it is, it's evolved in that direction.
But I think it's important. Yeah, it's important to say, though, that the reason why we got legal in the land bank event of default was not because the legal agreements allowed for it or because the structure of the debt listings requirements allowed for it. It really was land bank effectively, very kindly, actually, being a fair issuer, I guess, or trying to be fair, and helping us together navigate this event of default. That they said, you as investors in our land bank bonds, you can appoint one legal advisor to assist you with this restructure. There was no legal requirement for them to do so, and so I guess all we are asking for is to, because it might be that the next default, the borrower isn't that way inclined, and they may just decline, and then investors are stuck, and so that's why we wanted, in the principle, in the guidelines at least, that we've asked for that to be a kind of a standard term, that in the event of a credit event or a default, that one legal advisor is appointed to advise investors and act with a duty to us, but paid for by the borrower.
Thanks. One other question is, you have negotiating power. Why not put the power with the guys that are not selling? Olga?
We do have negotiating power but we are, and when I say we, I mean Futuregrowth, we are about investor of many, and so when an issuer comes to market, they may be issuing 1.5, 2 billion rand of a particular issue, and so if we are asking for things, we may be one participant in that particular auction, and there's another 10 that are not asking for that same thing. To do here is a better collective negotiation. So the power is in the collective negotiation rather than in the one. One voice is not going to change it. At the end of the day, it is in the collective power to negotiate, which we now have the platform in the ASISA guidelines.
Just to add to that, we've got a difficult situation, Masiabi, because of the requirements of some of the regulations pertaining to pension funds and unit trusts, where there is a big emphasis on listed, and also for non-insurers to participate in loans. So it's a complex question, and that's why probably the easiest solution was to put together a framework that made it clear what was best practice and what was commercially what investors wanted to see.
Thanks, Jill, for that. Yeah, I think that's the end of our questions. Could we potentially go to the poll and just see how people have answered the 2 questions that we asked them? Just waiting for those poll questions to come up, please. Maybe while we're waiting for the poll to come up, one other question says, considering the risks you highlight of listed bonds, are trustees of pension funds aware of the risks as their fiduciary responsibilities? And they can also add pressure if they know of the risks. I guess maybe my question to you would be, are you highlighting those risks to them so that they can know?
Look, one thing you must just, make quite clear is less risky than equity. In the company hierarchy, right at the bottom, the most risky piece is equity. And debt, that's higher up in the credit hierarchy or in the waterfall. And so, we don't want it to be people to perceive that debt is a toxic asset class. It's absolutely not. We just need the protections when things go wrong.
Absolutely.
Yeah, I think that's exactly right. I think that the risks is in the structural kind of unfairness of the market and the lack of sound lending principles, which is what we're trying to highlight and trying to improve.
Okay. We've got 1 minute left, so I'll just go to the poll. So one of the questions that were asked, some funds have a requirement to invest in listed bonds only. What should those managers be doing? And they have choice between A, B, C, D. 60% went for answer A, which says scrutinizing the legal agreements for each bond and actively negotiating with the issuer and the arranger for better terms. I think that has been stressed throughout the presentation, so it's good to see that people were listening and people feel passionate about the same thing. And then the second one that received 19% responses was C, which is pricing for weak terms and conditions. Then we had B, which is not investing in those listed bonds that have weak terms. And D is investing regardless of the weak terms and hoping for the best. I mean, Olga, it seems like all these answers are really true, right? I mean, there's no one that dominates the other. Would you say so? Or
well, I think maybe investing regardless and hoping for the best is probably not an optimal investment strategy, but I mean, I'm not here to tell other people what to do. I think it really does depend. It depends on the credit quality, it depends on the term, depends on what terms you've gotten, and it depends on what residual risks you can then price for. At the end of the day, it's a lending arrangement. The terms need to be fit for purpose, and there needs to be an appropriate risk reward framework. And it's up to each manager to assess that for themselves.
That's right. Okay, and then the second poll question, could that please come up? We've actually sort of run out of time, so those who still have time available, they can maybe stick around for the second poll questions. Those who wish to leave, we'd just like to thank you. We hope you've enjoyed the session and that you have learned a lot about, the bond market and, some of the things that, generally the industry is fighting for to make sure that, the listed requirements are fair and that they protect you as an investor so that you can get the requisite return for the risk that you are taking. Thank you so much. Please feel free to ask us questions outside of this. I'm available. Olga and Jill is available as well. You will see that our emails will be on the website as well, so you can access it. And I'm sure that, Shirley will also be putting up our profiles so that you can contact us. Otherwise, our BDMs are always there, the ones that have invited you. We'd like to thank you, and we look forward to engaging with you. Cheers. Okay, so for those who are staying, the last poll question, when was the first corporate bond issued in the exchange? A was 1992, B was 1897, and C is I don't know. So 55% voted for A, which is 1992, and 32% voted for I don't know, and B was 1897. Jill, when was the first corporate bond issued on the exchange?
It was 1992, and it was SA Breweries. And as I alluded to earlier, they issued their equity was listed in 1897. And the other interesting thing is that there was a corporate bond in the form of SA Breweries listed in 1992, but actually there was no more corporate debt issued until after 2000. It was, the one and only. And
Interesting. Okay. Thanks for that, Jill. Any parting comments that you'd like to make? Otherwise, we're going to close this webinar.
yeah, so I often say that bonds are treated like Brussels sprouts, and apologies to anybody who likes Brussels sprouts. Equity is seen as the wolf of Wall Street. And actually, well, I suppose I'm going to say Brussels sprouts are actually great fun. Otherwise, I wouldn't have spent 37 years in the bond market.
Yeah.
Sorry.
Thanks for that, Jill. Olga, any parting knowledge from you?
Yeah, really just to say, thank you for listening to everybody. It's up to each of us, right, as participants in this market to create a better market for our clients. So it really is over to all of us and to do, to fulfill our fiduciary duties and to make this bond market a fairer market for our clients.
Thank you. Have a good day, everyone.